Are you worried the housing market could crash again as it did in 2008? Don't be. Experts predict a cooling in average national house prices, but nothing as dramatic as a crash. In this video, we'll dive into why the housing market won't suffer too much and what to expect from the great home price collapse of 2022 to 2024. Make sure to hit that subscribe button and don't forget to click the bell icon so you can keep up with our latest content. Let's get started. Experts from Morgan Stanley predict that between June 2022 and the end of 2024, average national housing prices will decrease by about 10%. Although this may appear concerning at first, it's important to understand the context. A decrease of 10% is not nearly enough to qualify as a housing market crash, where prices typically drop by at least 20%. Even in the event of a deep recession with high unemployment rates, the expected decline would unlikely be as severe as what occurred in 2028. Several factors protect the housing market from such a deep downturn, making this projection conservative. Before we review which cities are likely to be impacted the most by this predicted dip, let's analyze these buffers. The market had been experiencing an unsustainable rally for 2 years. Since the pandemic's beginning, the large increase in home values has been unprecedented and, consequently, unsustainable. Wages have not kept pace with the housing market surge, so many potential buyers cannot afford such high prices. This has caused a slowdown in the growth rate and created an imbalance between demand and supply. The situation is further exacerbated by a nationwide housing shortage, putting even more pressure on prices. Despite recent price drops, home values are still 38% higher than they were in March of 2020. This level of growth cannot be sustained, and measures must be taken to bring the market back into balance. America's housing shortage isn't getting better. America has faced a housing shortage for some time, but the pandemic has only worsened. According to Freddie Mac and Up for Growth, America needs 3.8 million more homes to alleviate this issue. The National Association of Realtors estimates numbers may be closer to 7 million. Unfortunately, home starts have decreased by 8.8% in the last year, and applications for permits to build new homes have dropped by 10.1%. This means that the housing shortage will likely remain an issue for some time. As a result, renters may continue to pay more than 50% of their income to their landlords, since it is unlikely that home prices will drop enough for them to become homeowners. But the situation isn't as dire for those who own their homes. Despite home prices cooling off in most markets, foreclosure rates are still well below pre-pandemic levels, and there is not the same level of distress that caused many to be upside down on their mortgages in 2008. This gives homeowners a little bit of assurance that they won't lose their homes. As the housing shortage continues to take its toll, it is important to know how this may impact your situation. With the right resources and knowledge, you can ensure that you are well positioned to navigate this difficult period. Where are home prices dropping fastest? Home prices have not been entirely immune to downturns. The S&P Case-Shiller Index reported a 2.6% decrease in home values from June to September of 2022, slowing the rate at which they had been increasing year over year, 7.81%. This is a notable change from previous trends. The cities with the biggest drops were San Francisco at negative 10.36%, Seattle at negative 9.55%, San Diego at negative 7.24%, Los Angeles at negative 5.61%, Denver at negative 5.60%, Dallas at negative 4.34%, Portland at negative 4.25%, and Las Vegas at negative 3.69%. Even areas that had been seeing increases in home prices saw prices decrease from August to September of 2022. These data suggest that home values could be declining in many areas, and it may be wise to approach purchasing or selling property cautiously for the foreseeable future. Why is the cost of living decreasing faster in these cities? In San Francisco, the situation is similar to that of other major U.S. cities. Increasing unaffordable housing and higher, albeit slightly lower than in November, interest rates. The main difference here is that prices were already extremely high, so there was more potential for a bigger decline. San Francisco has been one of the most expensive housing markets in the U.S. for years, and so it is likely to experience a bigger drop in prices compared to other places. As remote working has become more widespread, many tech workers who are heavily concentrated in this region have taken advantage of the new opportunity to work from anywhere. As a result, San Francisco has seen an exodus of people leaving the city since the pandemic began, with around 6.7% of its population moving away between July 2020 and July 2021. This is partially because, with remote work, people can now choose to live in a more affordable area and save money in the process. Ultimately, this exodus has resulted in lower housing costs, providing potential buyers with more options beyond San Francisco's expensive real estate market. New York, meanwhile, has experienced a less significant decline in prices as companies there have implemented stricter policies on return to the office policies, meaning that more people are back in the city. Despite this, the situation is still far from pre-pandemic conditions, and many areas of the country remain greatly affected by the pandemic's financial implications. It remains to be seen how the various real estate markets will recover as remote working continues, but all signs point to a slow and steady climb toward pre-pandemic prices. In the meantime, it is important for potential buyers to know their options before making any decisions about home purchases in these cities. What trends should we look for in the housing market in 2023? Experts predict that U.S. home prices will decrease in the coming year, even though this dip will not likely bring more buyers into the housing market. This may lead to a further drop in housing sales by 2023 due to the difficulty of affording homes. The current housing market suffers from high mortgage rates, rising inflation, and recession worries. Mortgage rates have increased from 3% to around 7%, making it more difficult for individuals and families to buy homes. In addition, the costs of food, gas, and other essentials are increasing. Therefore, buying a home in 2021 is more challenging than ever before. Gaining access to affordable housing is an important step for many people to reach financial stability, and with the current market conditions, it may prove more difficult for potential buyers. It is important to consider all of these factors when deciding to buy a home. Despite the challenges, there are still ways to save money and make home ownership an attainable goal. Researching available options carefully can help buyers find the best mortgage rate and other benefits that can help them make the most of their investment. Mortgage rates have risen over the last year, but they have started to fall in recent weeks. The Mortgage Bankers Association estimates that by the end of 2023, 30-year mortgage rates will be around 5.2%. Other organizations such as Redfin and Realtor also have their own predictions for mortgage rates. Dennis Shea, the executive director of the J. Ronald Terwilliger Center for Housing Policy at the Bipartisan Policy Center, said that with a 3% or 7% interest rate, you would be paying out a substantial amount each month, even when housing prices decrease. Next year is expected to be tough for both buyers and sellers. However, it will be an important year in terms of helping get home sales back on track over the next couple of years. The NAHB predicts that single-family home construction will drop further. Additionally, Zillow forecasts that more people may come together with family or friends to purchase a house. Renting may also become more popular, with experts at Redfin and Zillow suggesting that prices for rentals could drop in 2023, and builders will focus more on rental properties. In 2024, the housing market will likely be a leading indicator of an economic bounce back. According to Dietz, by the end of 2023, either the Federal Reserve will have successfully maintained its inflation goals and will be able to reduce interest rates, or it may have overcorrected, resulting in a recession and necessitating a drop in rates. Either way, Dietz predicts that mortgage rates will fall, leading to an increased demand for single-family homes and a decrease in the current housing deficit by 2030. This could help provide some of the necessary momentum for economic growth through 2024. The housing market will never be the same after the great home price collapse. We must stay informed on this changing landscape to ensure our investments are safe and sound. What are your views on this? Which is the best investment strategy to benefit from this situation? Let us know in the comments below. Subscribe to our channel for more information and updates, and don't forget to like and share this video with your friends and family. Thanks for watching.